Hello, everybody, and thanks for joining us today. The primary goal today is we are going to review on the client portal the details of the plan section. So you should be able to see my screen here. Looks like we are waiting for a few individuals to join us. So I am going to give them 1 minute here, and then we'll kick this off and get started. So thanks, everybody, for your patience. Okay, so it looks like everybody is here. Let's go ahead and get started. So I'm going to get logged into the portal here. Okay, so once you get logged in, there's going to be a tab across the top called InStream. So when you click on the InStream, that's going to pull up the plan summary. So that's the plan summary is basically the high-level review of am I on track or am I not on track? If you click anywhere on the plan, that's going to bring up the available pages, and I'm going to select all these, so we'll just go over each one. So available pages is net worth, plan details, plan analysis, scenario matrix, cash flow, glossary, disclosure, and the appendix. So the current net worth summary, that's this section here. That's going to show all assets and all liabilities. Again, this is a demo account. We just have a few investment accounts in there. This is Joe and Jane. So next it's going to show the goals. We just have one goal in there. We have a retirement goal of $120,000 net after tax each year. And then this is our inflation rate. So the inflation rate is basically what we're increasing that goal amount by every single year. So it's also going to show the start year. So that is when we're anticipating to start this goal, which is at their retirement. Currently, Joe's 40, Joe's age is 40, and we're going to start this and continue this till Joe is 95 and Jane is 94. So this is going to talk a little bit about our allocations. So an allocation is simply what rate of return are we utilizing to grow the assets year in, year out based off of the underlying asset classes. So we can update these allocation periods for what we traditionally do is run one allocation period till we retire, or what we call a glide path, where we just slowly start changing that allocation as we get closer to retirement and actually through retirement. So this one here on this demo that we've set up this is what we've called their annualized return would be 6.33. The risk is 13.21, so that's standard deviation. So what that simply means there is, I'm going to zoom in on this section right here. So give me a second to get this. So if we look out 3 standard deviations, we would anticipate this portfolio to go up 19.54. If we go down, it would decrease to 6.89. So this is what we call your variance or your risk window. So looking at kind of a worst case and a best case scenario on what this portfolio could do over periods of time. I'm going to zoom back out. Okay. If we have cost basis on the accounts, that's going to show what total cost basis is, the value associated with it. If there's any contributions on the account, that will be in this section here. So if you're contributing to your 401k or 403b or IRAs, any of your accounts, the contributions will be in this section here. Then we're going to scroll this down to income. So this will be any income streams, kind of the foundation of the plan that a lot of you hear us talk about. So Social Security would be in there, pensions would be in there, any kind of income streams coming in. If you have real estate, maybe if you're a business owner, this is assuming we're making no additional contributions to the accounts. This is also showing Social Security inflated at 3%. We're receiving $36,000 a year for Joe and Jane. So this is the total amount in today's dollars for Social Security, and what we'd anticipate in total values with our inflation rate with Social Security as well. Then we're going to scroll down to tax rates here. So these are the rates we're going to use throughout the plan. This is assuming we're using the same tax rate throughout, so state income tax rate at 5%. This will always be adjusted based on the state you live in. And then capital gains tax rates, these will be updated based off of what current tax rates are. So as of right now, current tax rates or capital gains, we're looking at 15%. Then we're going to get into kind of the details of the plan analysis. So what this is showing here is that we have an 85% probability of what? So what that 85% probability is looking at is, if we go up, scroll up to here to goals, is we know our need or our goal is $120,000 a year net after tax from 2045 to 2073. Now, that is what we're going to need to pull from somewhere. So then the first thing we're going to look at is the income. Well, what are our income streams? Well, those are that Social Security pieces we talked about here. And then the balance is going to come from our investments. So what these simulations do is, when it's looking at these simulations here, it runs those thousands of different simulations as we had talked about, because we don't know if the market's going to go up, if it's going to go down, or if it's going to go sideways. So we're going to run all those different market simulations that are going to coordinate based off of this level of risk we have right here. So if the difference between the top and the bottom, so the variance on this here, I would call this basically simple numbers 27%, because we have 20% upside, 7% down. So if we take that in half, that's your standard deviation, roughly around 13. The higher this risk number is here, the wider the differences are going to be on all the percentiles. So what the 90th percentile is you basically have a 10% to be at this or above. 10% percentile is on the lower side. You have a 10% chance of that being at this amount or below. So what that means is of these, all the simulations we ran, only 85% of those worked. We believe running this type of analysis is much more efficient than just looking at average rates of returns, because average rates of returns is not how the market traditionally works. So this is our average age of shortfall. So what this is basically meaning is, out of all the different simulations, the average age, when the easiest way to describe is ran out of money, was age 88, and that average shortfall is we're roughly $2 million behind. Scenario matrix. So this will be an area which gives us a side-by-side scenario return or scenario comparison. This is what we'll see. You'll receive data in here populated. If you call and say, hey Chad, we're looking at buying a vacation home in Destin, we can update a scenario, and then that would be in the scenario matrix, which shows you various different options or changes to the plans. This next starts to get into the detailed reports of the cash flow. So this is showing beginning portfolio value, total net income, net goals. The reason almost all of these are zero is because we have not retired yet. So as I scroll down here, we're retiring at age 67. So our portfolio value would estimate would be at 6 million there. If I scroll up, the net income we want, if you recall earlier, we wanted 120, but we also know that inflation is going to come into play, so we're going to need 141. Then we're going to, I'm sorry, let me back that up. So 141 would be income off the portfolio that year. We're actually going to need 266. That's the total amount needed to fund our actual goals. I don't know. Let me see if I can get scrolled over here. It's not going to show me all the screens. Gross taxable distribution, tax deferred, tax exempt. This is going to show, there we go. Thought it did. It's going to take 1 second to update here. So what we're showing here is taxable distributions, tax deferred, tax exempt, total capital gains taxes, income taxes, your effective tax rate. And this is the simulated net return. So this is the simulated net return is the return we're utilizing in the portfolio based off of the risk. So as you can see, that return is varying year in and year out based off the risk that we see in the portfolio and how those have historically performed. So if we look here, taxable distribution we took out was 141 out of our accounts. Total capital gains taxes that year was 16,000. Total income taxes were right around 18. So this is what we would estimate our effective tax bracket would be that year, and then our effective portfolio value. So this year effective tax bracket, is calculated each year based off the amount we need to pull out and what that is. Disclosures are pretty straightforward. Obviously, these are analyses based on illustrations and based on estimations. That's why we run those 10,000 to get as close as we can to a realistic scenario as possible. This appendix here, this is showing that all of the asset classes, what we use to grow those at. So we'll go over U.S. small growth here as an example. The average 1-year return of U.S. small growth has been 8.84. The annualized return over a long period of time has been 5.69. The differences between these two is this is the average that is performed in 1 year, but this is the average year in, year out. Standard deviation is 25.14. So, as we talked about earlier, that's going to give us a wider variance on the higher that risk is going to make the variance between our percentiles higher. The lower the risk is going to make those more narrow. So if you're thinking of a road, the higher this number is here, the wider your road is. The lower the number is here, the more narrow your road is. So when you think about driving, if you're trying to drive down the center and we have a real wide road, we can swerve a lot to the left and we can also swerve a lot to the right. If we're driving down the road on a one-lane road, there's not a lot of room to go back and forth. So narrow road is less risk, which is going to narrow the difference between these three scenarios here, the 90th, 50th, and 10th percentile. So these, in the appendix here, these are just the various different average 1-year return, standard deviation, and annualized return for all of the different asset classes that are utilized. So this is how we re-illustrate what your portfolio would do going forward, or how we calculate those actual returns. So I'm going to scroll all the way back up to the top. So anytime you log into the portal, I'm going to deselect a couple of these. Just go back to current plan. Anytime you log into the portal, that plan is going to be live. Every night is when we rerun those simulations. Let me refresh this page. So that's going to update every single day. So let's say we have a major market downturn and you're concerned with, hey, is my portfolio still on track? We would have already ran those 10,000 different simulations. But when you click on the plan, if you're wanting to get kind of, let's say just you want to keep a report for your files, any of these available pages here, you can click on which ones you like, which ones you dislike, hit print the selected pages, and then obviously that'll create that report directly for you that you can add to your files if you would like to pull those. So these are always going to be live. The thing you cannot do with these is go back. In other words, for instance, the plans are always fluid, so you can't use a date and say, hey, what did this plan look like a year ago? We track that in our system, but that's not tracked live directly in the portal. So if you have any questions on this, please let us know. This is also another good checkup area. When you look at this, the plan details and net worth, maybe when we sat down, maybe there is a small pension that you failed to mention to us or forgot about. So when you're looking at the this income section here. So that plan's also going to be based off of whatever's in the plan. So this is the old, what I call GIGO analogy, garbage in, garbage out, when we're looking at data. The more detailed data we have, the better plan we can help you design. So if there's anything that you see that's missing or we needed to add, or as I mentioned, maybe there's a pension we forgot about, or maybe a small 529 for a child for college planning that you wanted to add in there, just let us know if we're unaware of it, and we can make sure that that gets added. Again, thank you for your time today. We appreciate it. We're super excited about having all these plans live on the portal. So it gives you kind of peace of mind of knowing when we're on track or off track as far as what your plan looks like. If you have any questions, let us know. As I had mentioned, our private client email address is concierge@Centorbi Financial. That's concierge@centorbifinancial.com. And you can email any questions. If it's specific on your plan or tweaks or updates we need, just let us know. Thanks and have a great day.